Good morning. Today we are going to start again from our classes. This is what we call 6M fundamentals of investment. Now we are going to start our fundamentals of investment become 6M. You are going to start our classes from where we had left the previous day, and you are going to start on approaches to equity analysis. We had left there the previous day. Now we are studying the fundamental analysis. Now we are studying quantitative fundamental analysis, and we are studying statement of cash flows. The statement of cash flows represents a record of business cash inflows and outflows over a period of time. Mm, Now, over a period of time means say cash flows are generally business cash flows are presented along with financial statements. Financial statements are presented annually, and they include the annual profit and loss statement, the balance sheet, and the cash flow. Because this is a part of the, if you are talking about reports, and if you are talking about statements, this is a basic difference. Mm, Now we have approaches to equity analysis. Now in our approaches to equity analysis, we have the quantitative fundamentals to certain quantitative fundamentals to consider. You have the statement of cash flows. Now it comes as cash flows from investing, or CFI. Now this is the cash used for investing in assets as well as in the proceeds from the sale of other businesses, equipments or long-term assets. Now cash from financing is CFA. This is the cash paid or received from issuing and borrowing of funds. Now, and operating cash flow, cash generated from day-to-day business operations. Now, cash from investing means the company invests in, lends to other companies, leases out assets or equipments, and so on. Cashes from financing means it either issues equity shares, preference shares, or raises loans through debentures and long-term loans. And operating cash flow means the company gains the cash flow from its revenue activities or its sales activities. Now, in operating cash flow, mm, uh, uh, operating cash flow can be normal revenue cash flow, and we are getting to the fundamentals and the ratio analysis. Now we have the first fundamental ratio analysis as the price earnings ratio. Now current stock prices, this current stock price is the current market price divided by earnings per share. Now in the price to earnings ratio, or it is um, better known as the PE ratio. And however, before we understand the P ratio, we must understand certain basic things about the PE ratio. This measure is very popular because it helps us in finding the companies whose price earning ratios are below the others of its kind. Now, in order to find out the ratio, we must divide the company's current stock price by its earnings per share. Now, what the main problem here is, or the idea, main problem or idea here is that we are, say, comparing the price of the P ratio of Reliance Petroleum with the P ratio of, say, Bharat Petroleum, or the P ratio of ONGC and all that. We are comparing such similar firms in the same industry, and we are comparing the basic industry position, and we are saying that, say, all the companies have this kinds of P ratios. If it is below, then it is undervalued. If it is above, it is overvalued, and then we may act accordingly. Now, for example, if the stock is selling for rupees 35 now, and its earnings per share or EPS were rupees 7, the P ratio would be 5. that is uh, 35 divided by 7, and earnings per share or earnings here is EPS. Now, what do we understand by the term EPS? We must first understand the term, basic term EPS. That what we earnings per share is earnings per share. Now, earnings per share or basic earnings per share is calculated by subtracting the preferred dividends from net income and dividing it by the weighted average common shares outstanding. The earnings per share formula looks like this. We are going to look at it in the next slide. The basic earnings per share, or it has basic and both diluted earnings per share. We're going to discuss this in the later slides. We're subtracting the preferred dividends. Now, from the net income means after paying off all the interest, taxes, whatever amount is left, that from that we deduct the preference dividends, and what income is available or what profit is available to the what is left over, we divide it by the number of shares. Now the earnings per share formula looks like this: net income minus preference dividends by weighted average common shares outstanding. Now we understand the term net income. We understand the term preferred dividends is the dividends that we pay on the preference shares. But why do we have this weighted average common shares outstanding? Say for instance, we have different types of common shares. Different amounts of common shares in the beginning of the year, the say 10,000 shares were issued. During the middle of the year, say 2,000 more are issued. During end of the year, say we have 12,000 shares outstanding. So we have to divide it accordingly, the whole weighted average accordingly. That is 10 by 22 into so much into the weighted average. We have to common shares outstanding. We have to calculate it in that manner. Now, this is a method of calculation. Now, we have this method of calculation because throughout the year, the total number of shares outstanding may or may not remain in the same. And there are very good chances in practical life that it does not remain the same. Now we have EPS or the earnings per share. We have another variation of that formula. Say net income minus preferred dividends by end of period shares outstanding, and EPS as before, net income by preferred dividends by weighted average shares outstanding. Now, end of period shares outstanding is generally the normally used formula that is used for the calculation in by the people that work every day or by the people that uh, say are using exams and all that. Weighted average is actually used by share analysts because they actually have real-time figures from the various websites for all the shares that are outstanding, and they have this weighted average formula calculated in their system. So they just need to put the value of their share and they will get this EPS value. So for all practical purposes, we can use either any of these formulas according to the situation, and we can get the end result quite accordingly. Now we have the approaches to equity analysis. The first formula uses total outstanding shares to calculate EPS, but in practice, the analysts use the weighted average outstanding when calculating the denominator. So, however, because the analysts they have access to more amount of data, and as the outstanding shares changes from over time, say some shares may be forfeited because all the people they may not particularly pay up the whole share capital. They might have paid up some of the share capital and the amount is outstanding, and that amount might not have been paid up. So analysts often use the last period shares outstanding. So the end period is given. So if we may not have access to all the data. So this is all for the day. We'll continue in our next session.